Imagine a stock market, but instead of trading shares, it's electricity. That's the Indian Energy Exchange, or IEX. Power producers sell surplus electricity, and big consumers, like factories, buy it in real time, all on one digital platform. Before IEX, buying and selling power was slow and inefficient. Now, it's fast, transparent, and efficient. IEX connects thousands of buyers and sellers, matching supply and demand instantly. Prices are set by the market, ensuring fairness. IEX doesn't own power plants or wires. It's a tech platform earning a fee on every trade. With over 90% market share, IEX is the go-to place for short-term power trading in India, a near monopoly with a powerful network effect. This makes IEX a critical part of India's energy infrastructure and a unique investment story. It keeps the grid balanced, reduces waste, and helps keep prices stable. Understanding IEX's role is the first step to deciding if it belongs in your investment portfolio. IEX's financials are impressive. Steady revenue growth, high profits, and operating margins often above 80%. As a tech platform, its costs are low, so most revenue turns into profit. The company is debt-free and pays regular dividends. But there's a catch. IEX's monopoly and profitability mean its stock has always been expensive, with a high price-to-earnings ratio. When growth slows or trading volumes dip, the stock price can fall sharply, as we've seen recently. The valuation has come down from its peak, but it's still not cheap. Investors must ask, does the current price reflect future growth? IEX is a cash-generating machine, but high expectations mean any stumble can hurt the stock. Weigh the business quality against the price you pay. The financials are strong, but the stock often comes at a premium. The IEX stock chart shows a story of excitement and caution. After a big rally in 2021, the stock has been stuck in a long sideways range, bouncing between support and resistance. As of July 2025, it's hovering near key support, with technical indicators like the 200-day moving average and RSI showing indecision. A breakout above resistance could start a new uptrend. A breakdown could mean more weakness. For traders, this range offers buy low, sell high opportunities, but requires discipline. Long-term investors should be patient, waiting for a clear signal before committing big capital. The technicals say IEX is at a crossroads, waiting for a catalyst. The next move will depend on fundamental developments. IEX's biggest growth driver is India's rising power demand. More factories, homes, and electric vehicles mean more electricity trading. The government's One Nation, One Grid policy and the green energy push make IEX even more essential. As renewables like solar and wind grow, IEX's dynamic market helps balance the grid with new products for green energy trading. But there are risks. The biggest is regulatory. Market coupling could force all exchanges to use a single system, threatening IEX's dominance. This uncertainty weighs on the stock. Competition is also rising, with new exchanges trying to grab market share. High valuation remains a concern, especially if growth slows. The future is bright, but not without challenges. Weigh the powerful growth drivers against these real risks. So, should you buy IEX in July 2025? It depends on your goals and risk appetite. Long-term investors may see IEX as a play on India's growth and energy transition. Accumulate gradually, ideally on dips, and use a SIP approach to manage risk. Short-term traders should be cautious. Trade the range or wait for a breakout, but use strict stop losses. Diversification is key. IEX faces real regulatory risks, so don't bet too much on one stock. Think of IEX as a high-potential, high-risk part of a balanced portfolio. The company has strong tailwinds, but also faces headwinds. There's no simple buy or sell answer. Study the business, weigh the risks, and decide if it fits your goals. Do your own research and invest wisely.